Morning, everyone. Thanks for joining us this morning. It's just turned 11 o'clock, so I'm going to start today's investor briefing. Thank you for joining us. My name is Beth Moylan, Head of Growth at Novatti, and I'm joined today by Mark Healy, CEO of Novatti. Mark has been on a mission to transform Novatti into market-led, customer-focused organisation and to make payments not just seamless but also successful, supporting businesses across Australia and New Zealand and with award-winning payment solutions. We welcome you to submit questions, participate and add questions, as many as you like, into the Q&A box at the bottom of the screen. And at the end of the session, we will spend some time going through those and coming back to you. So Mark, let me hand over to you.
Thank you, Beth, and good morning, everybody. And thank you for taking some time this morning to join our Q4 update. July actually marks the second anniversary of my tenure as CEO. And so today I'm pleased to share that our turnaround is at a key inflection point. A consistent period of methodical strategy execution is now enabling Novatti to pivot back to growth. The key outcome of our turnaround work to date is that we now have a sustainable business. For those of us following us closely, we have a very clear and focused strategy. We're continuing to execute strongly on that strategy. And our Q4 highlights our momentum in lifting financial performance, with quarterly revenue at a new record and a significant reduction in the use of cash. We are continuing to work on many initiatives in parallel to reposition the business, to remove impediments to customer acquisition, and to build a business that can take advantage of the many opportunities in a very dynamic payments industry. Firstly, for anybody new, a quick recap on our value proposition and our competitive advantage. This slide represents our core business, the ANZ payments business, which is the centerpiece of our strategy. There are numerous other products and services we provide and other markets we operate in, but they are not core and are flagged for either divestment or run-off over time. In the ANZ market, our strength and our point of difference is we can offer an end-to-end suite of payment types and methods across acceptance and issuing, including cards, account-to-account payments, billing systems, Asian wallets, international payments, and global currency accounts. Through a single relationship, we enable the business to both make payments and receive payments, be they in-person, online, or cross-border, to simplify their operations and enable a consistent experience across all sales channels for a customer. In effect, we are a single destination and a single relationship for payments. And importantly, we do that in equal measure across both Australia and New Zealand, which I believe is unique amongst the plethora of non-bank payment companies in this market. We're almost exclusively B2B focused, and we enable our customers to operate their businesses more efficiently with our multi-sided solutions. It's always worth a reminder of just how far we've come since the start of FY24. At that point, the company that I took over as CEO was effectively 12 separate businesses without any effective cohesion or synergies. And in the immediate prior year, had posted a circa $15 million underlying EBITDA loss. Since that time, our turnaround has been enabled through developing a clear strategy and delivering against it. Simplifying the business, moving to a market-led customer focus, and lifting our financial performance, which is where we are now seeing momentum really build. The business is now very focused on payments at our core. We are positioning in market around the value proposition of total payment solutions across both Australia and New Zealand, and the whole business is focused on consistent execution. In terms of the immediate quarter and performance in numbers, the two metrics I get asked about the most, and understandably are front of mind for many on the call today, are profitability and cash flow. So we're focusing on those today. We achieved our EBITDA positive target last quarter and have traded strongly since then with a record revenue quarter in Q4, albeit returning to a small negative EBITDA position. Firstly, streamlining and cleaning up one of our non-core software businesses for divestment and a $400,000 set of write-offs and provisions that skewed the bottom line result, plus some incremental investments we've made in the quarter in our pivot back to growth. With a sustainable P&L, we are now laser focused on cash flow, with cash used in operations the primary metric to improve. Off the back of a series of decisions and results, we've been able to reduce our cash burn by almost 50% in the second half of FY25, highlighting the significant progress being made here now. Getting this measure to zero and then to positive is the number one focus of the leadership team, and we are building capability to support that, including, for example, the recruitment of a new CFO who joined us several months ago and is already making his mark. And just as a point of note, Hayden will be joining me in our future webinars after he fully settles in. Hayden brings a very strong background in commercial finance, which will be a great assistance in the drive for higher margins in our revenue composition as we pivot back to growth. Historically, we were a very confusing company to both understand and to deal with. This negatively impacted our brand, our market perception, and even our standing customer relationships. A brand refresh went live in Q3. This was an incredibly important and has and will provide a platform to target new opportunities with clear and coherent messaging. Following this refresh, we've used Q4 to start to accelerate our sales activities. This approach has led to several new deals with mid-market customers, which represent our ideal customer type. In addition, I'll point out the Care Economy CRC program. This is a recent federal government-funded initiative representing a $129 million 10-year partnership of 60 organisations across Australia to collaborate on innovation, technology, and data solutions to address challenges in the care sector, including greater innovation for care-based payments. Novatti is the only payments company officially embedded in the Care Economy program. As we pivot to growth, our focus is also on removing any impediments to customer acquisition. We are making selected, moderate investments into a number of projects to enhance the customer experience, uplift our capabilities, and improve our revenue composition. So just stepping down into that last statement in a little bit more detail, and again, as context, we are specifically targeting medium-sized businesses as our ideal customer. These are companies, or rather fintechs, that are growing, internationalizing their businesses. They have multiple sales channels and more complex workflows for payments. They've likely grown out of vanilla or monoline products and are looking for a total payment solution via a single relationship. For these customers, we are solving real operational pain points or supporting their own digital transformation. For these mid-sized customers, payments represents what we do, but we are effectively selling them trust. So to grow in this space, we need to provide a tier one solution with the capabilities and performance to guarantee that trust. Across our various product sets, Novatti does not own or control the entire technology stack, and historically the company has partnered with several vendors that don't meet our current standards and are impeding sales opportunities and conversions. So in Q4, we accelerated a decision and the investment into a processor upgrade to a best-in-class tier one provider, which is now completed and customer migrations are underway. More broadly, across process, product, and technology, our focus in the near term will continue to be on removing impediments to future growth and customer acquisition. We'll make moderate but targeted investments to enhance the customer experience, uplift capabilities, and enable Novatti to pursue both larger and higher margin opportunities. To summarize and conclude, a consistent period of methodical strategy execution is now enabling Novatti to pivot back to growth. Our Q4 highlights this momentum in lifting several key financial performance measures. And the Q4 and beyond pivot back to growth will follow the same approach, executing methodically and consistently against our strategy. Looking forward then, as we unlock growth in our core ANZ business, we'll continue to simplify and streamline our portfolio. We'll continue to act on low margin, complex or uncompetitive offerings to improve our revenue composition, as we did with the withdrawal from our cross-border wholesale services earlier in the year. We'll continue to improve our infrastructure and our key vendor relationships to remove impediments to growth and support innovation. We'll leverage the brand refresh to enhance awareness and support our targeted go-to-market activities. And we'll continue to improve our cash flow to reinvest back into our core to fuel that growth. At the right time, we will consider accretive acquisitions to also help achieve a scale position across the Australasian market. In summary, we're now a very focused company, and continuous improvement drives the culture inside the business. Moving forward, as we pivot back into growth, we'll follow the same methodical execution that you've seen demonstrated consistently over the last year. And executing on our growth strategies, underpinned by improving the cash flow position, will continue to be our benchmark metric moving forward. Thank you, Beth. And with that, I might open up to questions.
We've had some great questions so far, so thank you very much for everybody that's contributed already. Just a reminder for those that haven't, that do want to add anything, please just submit in the Q&A box at the bottom of your screen, and we will make sure that we get back through to everybody, either in this session or beyond. The first question we had was around, you mentioned about improving revenue composition, and you mentioned that several times in the announcement. What impact is that going to have moving forward?
Well, I think the short answer to that is a very positive impact. The company actually has a very diverse set of products and services, particularly outside the ANZ core, and we range from a 2% gross margin to a 90% plus gross margin across those products and services. As we continue to build out that ANZ business, we'll accelerate the exit from a range of historic low margin revenue lines and shift to a higher margin revenue focus. That'll be driven by the higher value that we deliver from the total payment solutions approach to our target customers.
Thank you. I've got another one here around it's asking, can you provide some insight into whether the brand refresh is providing results and the commercial traction around that?
Well, it's still very early days. We're only several months in post the refresh, but the feedback has been very positive. And we're seeing higher quality leads come through into the business, and also leads with greater alignment to our ideal customer type. In more tangible terms, we've seen multiple existing customers extend their services and their solutions with us. We have good progress in building the sales pipeline for the ANZ core business. And we've seen, as I outlined, several new mid-market customers and opportunities engage with us around our wider value propositions.
Thank you. There's a question around the processing platform. There's a question that says, was the processing platform investment worth it at this time?
Again, the short answer is yes, very much so. It is a fundamental enabler of our pivot back to growth. And also, I'd add, for the retention of some of our key customers in the current portfolio. Greater innovation, enhanced service delivery around our processing will unlock larger customers, unlock higher margin opportunities, and remove some of the pain points from customers taking a wider set of products and services from us.
Thank you. The next question I have is around the cash used in operations dropped by 48%. What is the pathway forward?
So more of the same, really. And by that, I mean just simply methodical and consistent execution. We've managed the P&L to a sustainable position now, and we will do the same with cash flow. So the pathway forward really shifts from a focus on restructuring and cost optimization to a pivot back to growth, improving our revenue composition, driving at higher margin, continuing to manage costs, and divesting of non-core assets to focus on building up and out the core business.
Thank you. Thanks. There seems to be a good few questions, so thank you. What are the next steps in your pivot back to growth?
So in any turnaround, and this one is a large one, there's not a single lever or program of work. We are executing on multiple streams of work concurrently. Perhaps the best way to answer that question is if I go back to this slide, which is my concluding slide. So these, you can see through we are now here sort of area on that slide. And these are really the next steps, and they're not in any particular specific order that I would add. We will leverage the work that we've done thus far and our existing customers for organic growth. We'll continue to accelerate our sales focus and our sales engine on acquisition. Continue to improve our vendor supply chain to uplift the customer experience. And on both an immediate and constant basis, work to improve our cash flow position as we do so.
Thank you, Mark. Where are you going with your cash EBITDA target now? That seems to have been missed for Q4.
So I would say that our EBITDA target effectively doesn't change. We reached a positive result in Q3 and have traded strongly through Q4 with a 9% revenue growth quarter on quarter. However, that result largely was driven by growth in a low margin product in our international business. So with the preparation for a specific divestment and some provisions that were taken up, as well as that investment in the processing upgrade, which is circa $120,000, we've seen the EBITDA flip, but we're talking still relatively small numbers. So our pivot now is to growth, but very importantly, we will be executing on that in a manner that doesn't change our EBITDA goals and that also improves our cash flow position moving forward.
Thank you. There are a couple of questions around AUDD. Where is the company with AUDD? Where does AUDD fit into the rollout, into regulations rollout?
Yeah, look, it's a really dynamic area right now. We're seeing a lot of movement in the US market, particularly in and around regulatory certainty around the stablecoin environments, which is driving a lot of dynamism and also investment. So the AUDD stablecoin sits in our investments pillar. And so we are the majority owner of AUDC at this point in time. However, we will not be continuing with the funding or any future capital raisings for AUDC. AUDC is the issuer of Australia's leading AUD-backed stablecoin, and we really see it as a strategic growth platform into the digital asset economy. They are making good progress in terms of their business plan. It now has institutional grade infrastructure and compliance and is really well positioned for scale and global relevance moving forward.
Thank you. There's a question around cross-border payments too. Can we elaborate more on the cross-border payments aspect of the business?
Sure. So again, just sort of going back and giving some context and history. Originally, there were two components to our cross-border services, effectively wholesaling our infrastructure and capabilities to money service businesses for a B2C environment and international remittances. That was a larger part of the business. And then the smaller part of the business was as an adjunct product, a complementary product to our B2B customers, effectively importers and exporters that were making payments in and out of a global currency account for things they import from overseas and to enable local collections for overseas-based customers. The latter is retaining, so we still have a B2B focused business and that global currency account, and the ability to offer that currency account is an important part of our future service offering. But it's that wholesale facilitation for intermediaries that we have removed ourselves from, and that was flagged earlier in FY25, and we effectively just concluded the withdrawal from those services and customers through Q4.
Would you be able to give an update on the 500 plus customers?
Yeah, so that plus 500 was in the merchant acceptance part of our business, and I think in the last quarter we indicated we were on or about 50% of our way through that on successful onboarding. We have temporarily paused with the upgrade to our payment processor in that space. We have temporarily paused the onboarding of customers until we've got the customer migration and that new platform fully live.
Thank you. Would you be able to give an update on rent pay as well, please?
Yeah, so the important thing about rent pay, in which we have a very small investment in low single digits, is that it sits in one of our three target verticals, being real estate. We view that market as being very important and offering up great opportunities for us to grow in terms of our ideal customer type, both in terms of direct to merchants and through other fintechs and software platforms. RentPay provides one of those opportunities for us to distribute our product, and they are continuing to grow and grow well, and we continue to support their growth with enabling them with a range of payment products over time.
Thank you. And then I have a question around, let me just find it, sorry. Around the fees and surcharging. How is Novatti impacted by the removal of fees and surcharging?
Yes, I thought this question might come up. It's the thing about surcharging is that it has become a political and regulatory football, and so my own view is that the policy decision reached by the RBA is in fact a good one. The framework around surcharging was put in place a long time ago, circa 20 years ago. The payments environment has changed significantly since that point in time. I don't believe that policy outcome was really achieved in any great sense. And so I'm a supporter of the move to remove surcharging from the market. However, I actually don't believe, and I have a different view to the outcome that the RBA thinks will occur. In terms of the impact on Novatti, we have a very small percentage of customers in our merchant acquiring business that are surcharging. It's high single-digit percentages, so it will have a negligible to no impact on the Novatti business, from any financial or operating perspective.
Thank you. Would you be able to speak a little bit about the university and our connections there?
So I can't share the name of the university just from a commercial and confidence point of view at this point in time. But it's, we have one of our key target verticals again, and one of the early areas of a demonstrable growth for Novatti in the merchant acceptance space has been the education vertical, and particularly in the tertiary education vertical, and again, particularly for international students and tuition payments. We have some time ago completed an integration through a software partner that provides effectively an ERP style solution to circa 30 universities around Australasia, and it's through that relationship that we have enabled this recent large New South Wales based university to facilitate international tuition payments for international students. And so we're very excited to see that go live, and to also then start to extend that offering through a range of other universities around Australasia through that software integration.
Thank you. I have a question here around what do you think differentiates Novatti and our offering versus competitors?
Right. So I think again the best way to answer that question might be to go back to this slide. Hopefully that slide is coming up. Essentially, it's the breadth of our offering. So the payments market across Australasia is very well populated, but highly fragmented, and generally payment service providers provide a single product or potentially one or two products. The difference with Novatti is the breadth of that value proposition and the ability to provide an end-to-end payment suite of products and services through a single relationship. So what we offer is the ability for these mid-sized businesses that are growing out of those very good sort of monoline solutions from a range of other providers in the market, both local and international. But we're enabling them as they grow and internationalize and want to customize their customer experience. We enable them to drive their own experience in the market, to adapt the experience to one that they want to put in market, and to have a single relationship for an end-to-end set of payments offerings.
Thank you. There's a question regarding immersion. Was immersion divested, or whether does that relate to the US?
Yes, it does. I think that's relating back to one of the points we made in the release this morning. So what we've done with immersion as part of the streamlining of the business and the simplification of the business is withdrawn it from the US market. It has for a number of years now been attempting to grow into the US market. That decision was made before I arrived in the business. That has been very difficult, has not been a success from an operating or financial point of view. And so during the course of the last 3 or 4 months, we have made the decision and enabled the withdrawal of immersion from the US market to improve operating and financial performance.
Thank you. Would you also be able to give an update on ATX?
Yes, in a similar way. So ATX sits in our international business. It's a bill payment, effectively a bill payment solutions provider in the Malaysian market that was acquired some years ago. Over the course of the last couple of years, we've been working very hard with the local management team to bring that from an extended period of underperformance, both operationally and financially. And in the recent quarter through Q4, that has been successful, and we expect that to now be contributing to the P&L with a small EBITDA positive position going forward.
Thank you. And there's a question regarding when do you expect the movement of the sale of non-core parts of the business? Will that be this calendar year?
As part of the ongoing streamlining of the portfolio, we have been engaged in a number of discussions with a number of parties around multiple assets in the portfolio that sit outside the core business of AUNZ payments. That is ongoing. We're in discussions right now again around multiple assets. In fact, there are 3 at various stages in that process. And we'll update the market as and when we get to a firm and binding offer position for any of those assets.
Thank you. The last question, probably, because we're almost out of time, is what's the future revenue goal?
So we haven't given guidance around a specific revenue goal. I'll just go back in terms of, again, to one of these slides here around the strategy. So the strategy is underpinned by 2 very clear and specific targets, and they are driving the business to a positive cash flow position and to our 3-year 70% margin targets. And so through the course of achieving both of those things and building a sustainable and repeatable business, then we'll be in a position to indicate that top line growth and where we see ourselves from a revenue position in the future.
Thank you. Thank you very much. I might close it there. And if there's any other questions that you have post this webinar, feel free to email them to us and we will respond to you. Mark will reach out to you. Thank you very much for your time today, Mark. And thank you to everybody that's contributed, joined in and attended and participated with questions. The recording of today's session will be sent out, will be on the website later today and then be sent to you shortly. Thank you very much.